The everything bubble is massive, bonds have been in historic bubble territory ever since the early 80s, the stock market is at insane levels, the real estate market has become incredibly overvalued, but at the same time gold and silver look to be pretty undervalued with a historical context. In this video, I'll analyze the way I intend to profit from gold and silver in the upcoming global recession. Before I explain the ways one can invest in the sector, I want us to go through the severe overvaluations of the other asset classes I just mentioned. And as always, all is said with educational purposes and should not be meant to be financial advice. On the next chart, we can see how until recently, bonds were at their lowest yield levels in history. During the early days of the pandemic in 2020, the 30-year US bond yield hit 0.5%. This means if you lend the US government money for 30 years, you will get a 0.5% per year return. This is abysmal and it just could not have stayed like that. The current yield is 4% and it started to come back to normal levels due to the start of the interest rate hikes by the Fed. The Fed started to hike rates because this is the main way for them to stop the inflation rate. By increasing the rates, credit becomes more expensive for both new and existing credits. This means less people can afford to take out loans and the old loans start to be repaid faster. This brings the overall consumption down and with it the money in circulation is also going down. When this happens, the inflation rate starts to go down as well, but not immediately. The higher the bond yield, the more risk a system has in the eyes of the investors. Ever since the 80s, according to the bond yield, the risk for the US economy was only going down. But this is not the actual reality. Over the last 40 plus years, the US government and the Fed have been printing trillions upon trillions of dollars, and with a lot of that newly printed money, they bought their own bonds. This makes it so that there is artificial demand for this asset, and due to this, yields started to go lower as money flows to the market. As you can see, even today's levels of around 4% are not high in relation to the last 60 years. Let's now discuss the stock market. According to the great Warren Buffett, his favorite gauge for evaluating in a quick and easy fashion the stock market is the so-called total market cap of US stocks divided by the GDP of the economy. On the next chart, we see this indicator, which is also called the Buffett indicator, due to it being the favorite metric of Warren. The current level sits at 151%. This means that the US stock market is 51% bigger than the US economy. This is not normal, but what is even more impressive is that about a year ago we went above the 200% level. The historic trend line currently is sitting at around 120%, meaning that a fair value for the US stock market in relation to the US GDP is for it to be about 20% higher. When Buffett made the statement about his affinity for this metric, it was during the late 90s when again, according to this metric, the levels were extremely overvalued. What is important to understand in finance is that when we have massive over or undervaluations, usually we almost never go back to fair value. Most of the times, prices overshoot to the other direction. Just like in the late 90s, after the massive overvaluation, we did not go only to the historical trend line, we went down quite a lot more. This is what is going to happen most likely now, but we should be happy about it, as the greatest opportunities arise in these moments. Another way to analyze the current state of the market is by looking at the S&P 500 PE ratio. The average level for the last 100 plus years is around 16. The current level is 27.66. The PE stands for price to earnings, and it tells us that on average throughout history, investors have paid $16 for each dollar of earnings stemming from US public companies. Now they pay $27.66 per dollar of earnings, which is close to a double. About a year ago, the level was 39, which was close to the all-time record set in 1999 when the ratio reached 45. The current level is close to the Great Depression's level in 1929 of about 30. From this perspective, we can go much lower. The third metric, which is also used to analyze the market, is the Tobin-Q ratio. It is often called a hidden gem metric as not a lot of investors know about it, but it is very comprehensive and proven throughout history. The Tobin-Q ratio is found when we divide the total market cap of US stocks by the total assets of all companies. According to this ratio in history, the average level is 74. Which means that the market cap should be about 74% of the value of all assets. The current level is 55% more than that, but about a year ago we reached a record-breaking overvaluation when the level was 137% higher than what is considered to be normal. What needs to happen now is we need to overshoot to the downside, which means we must be able to buy US companies in the near future for quite below their asset costs. For example, in 1979, we could have bought the US market with a 62% discount to the historic average, or in other words, for about 30 cents we could buy $1 of productive assets, which is an incredible bargain. The same times will come again. Let's now move on to the real estate market. The best and most proven way one can make a general analysis of the real estate market is to look at the long-term price-to-income ratio. On the next chart we can see just that. The average level is 5, the current level is 8, which means the US real estate market is about 60% overvalued in relation to history. The massive liquidity that was pumped in the system made it so that a lot of people invested in the market and they took out very low interest rate loans never before seen in history. But as the Fed starts to tighten the monetary system, this market has no way to go but down, at least for some period of time. The current levels are going much higher even in comparison to the great financial crisis of 2008. Which was in large part due to the high real estate prices. Let's now discuss the ways one might protect himself and even profit in the upcoming crisis. When all other assets are overvalued in this way, gold and silver always performed well. They are assets with millennia-long history going back to more than 5,000 years ago. They are famous in the sense they offer incredible war, inflation, and most of the time recession protection. But it is important to understand how to evaluate them. What is a minus for these assets is that they do not produce cash flows, which makes it hard to establish their real or so-called intrinsic values. When we analyze a bond, a stock, or a property, it is much easier to find out the true value, as there are multiple ways to do this. When we're talking about gold, the best information to use is to see the Dow to gold ratio chart. The Dow gold chart now sits at a level of 18. The average level is between 8 and 9 over the last 80 years. This means that now we need 18 gold ounces to buy the whole Dow index. The average level is about 8 to 9 ounces, but the low was hit in 1980 when the ratio hit 1. Below 8, gold starts to become overvalued in relation to the general stock market. Above 8, gold starts to become undervalued. The highest undervaluation for gold was reached in 1999 when the ratio was more than 40. So for now, gold is looking pretty good compared to stocks. Silver, on the other hand, is best to be analyzed in relation to gold. For this, we must use the gold to silver ratio. The average level is 56 over the last 100 years. This means that we need 56 ounces of silver to buy 1 ounce of gold. Below 56, silver starts to get overvalued, and above 56, silver starts to get undervalued. A general rule of thumb is below 30 to start selling silver and buying with it gold, and above 70 is a good time to sell gold and buy up silver. If you buy silver when the ratio is 70 and then the ratio goes to 35 and you sell it, you can buy twice as much gold with your silver holdings. The current level sits at 95. This is the fourth most undervalued level in silver's history. This means that over the last 100 years, there have been only 3 better times to buy up silver than now. And remember that gold and silver are directly correlated. If gold is expected to rise, silver will rise as well. But silver is more volatile, usually by a 1-to-3 ratio according to David Morgan, the so-called silver guru. 1-to-3 means that if gold rises by 1%, silver tends to rise by about 3% over the midterm. I am currently heavily buying up silver and I believe in the data and in history, and sooner rather than later, these safe haven assets will shine brighter than ever. If you're interested in more content about precious metals, make sure to subscribe and hit the bell icon so you won't miss out any of our upcoming content. Let me know in the comments down below me to cover another topic. Thank you for watching until the end, and I'll see you next time.